Hola, welcome to Basics Simplified. So today we're going to be learning about cash reserve ratio, also called as CRR. It's yet another monetary policy tool of the RBI like repo rate and reverse repo rate, which we learned earlier. Before we learn what CRR is, we need to learn a very important concept, that is net time and demand liabilities. Why do we have to learn NTDL? It's because NTDL is a really important part of tools like CRR, SLR, MSF, etc. Okay. So what is NTDL? Remember your parents telling you to put your money in banks for safekeeping and stuff, to create FD, RD or a savings account or anything? All those come under NTDL. NTDL basically is the liability of a bank towards its customers for the deposits they receive. Okay. What does the time part stand for? Any money which you invest in anything like a RD or an FD which has a time frame attached to it. Okay. So they come under time liabilities. What about demand liabilities? When you open a savings account, when you open a current account, or even draft a DD to pay to someone. DD, which is a demand draft, right? So all those things which has a demand tag attached to it, anything which the bank has to pay on demand, they come under demand liabilities. Your savings account, your current account, your demand draft, etc. Okay. So now that you know what NTDL stands for, learning CRR is much more easier. CRR is the amount of cash a bank has to maintain as part of its total deposits, which is its NTDL. Okay. So in today's situation, a bank has to maintain 4% of the NTDL as CRR. Okay. Let's assume with an example. Say a bank has an NTDL of $100 million. Okay, so out of $100 million, which is its total NTDL, the total deposits, the bank has to set aside a CRR and can lend only the remaining. So if $100 million is the NTDL, we learned that CRR is presently 4%. Okay. So when CRR is 4%, how much would the bank have for CRR and for lending purposes? Pretty easy. Bank would save up $4 million for CRR and would lend the remaining $96 million for its lending purposes. Got it? Is this understandable? Okay. Now you would have a question saying, what does this 4 million accomplish? And would the bank gain anything from the 4 million? Okay, since we are putting our money in banks for safety purposes, the banks should also be safer when it has a lot of money. That's why RBI uses CRR. By having this money saved up as a reserve, in case anything bad happens in the economy, not every bank going bust would still have some money left, which is untouched. Okay, that is your CRR. Okay. The second question, what would happen to this money? This money can be kept in either a bank cash vault or it can be kept with the RBI. So since it's cash reserve ratio, some banks have their own cash vault to store this money, or they lend it to, or they store it with RBI. Okay. The most important point is, does this 4 million give interest? No. This 4 million does not earn any interest for the banks. So what do the banks do when they need to make money? They have to make money out of this 96 million. Okay. And how do they do that? They charge interest rates. Got it? By charging interest rates on this 96 million which they are lending, they make a profit or they make up money to keep going in a circle of business. Okay. Now what would happen if CRR is increased or decreased? It's pretty simple. If your CRR is increased, okay, from 4%, it can go to say 6%, which means that out of the 100 million, the banks would actually have 6 million in CRR and only 94 million in the lending part. What does this mean? Banks have lesser money to lend, which means increase in interest rates. Okay. And what about if CRR is reduced? It would go from 4% to 2%. Okay. Which means banks would only put $2 million in CRR and would have 98 million for lending purposes. Okay. More money for lending, which means what? Lesser interest rates, reduction in interest rates. Now your question is, okay, CRR is maintained for safety purposes. What is the reason that MPC makes use of CRR when it releases the increase or decrease values? MPC uses CRR for inflation. This is the amount of cash that is kept away from the public, right? So if this is increased, it means more amount of cash is kept away from the public, and if this is decreased, it is less amount of cash kept away from the public. So by increasing or decreasing CRR, MPC is able to either control inflation or cause inflation. Got it? Thank you.